You've probably heard it a million times. High risk equals high reward. It's the cornerstone of modern finance. But what if it's just plain wrong? What if you could actually get incredible returns by taking on almost no risk? Well, that's the whole idea behind Mohnish Pabrai's book, The Dhandho Investor, and it's what we're going to break down right now.
The whole philosophy boils down to this one word, Dhandho. It's a Gujarati term, and it basically means a venture that creates wealth. But here's the key twist. It's about doing it with virtually no risk. The Dhandho mindset is simple. Heads I win, tails I don't lose much. It completely flips that old risk-reward model on its head.
And look, this isn't just some theory. There's an amazing real-world story that proves it works. Back in the 1970s, Patel refugees came to the US with next to nothing. They spotted an opportunity nobody else wanted, run-down motels being sold for pennies on the dollar. So they bought them, lived inside them, and the whole family pitched in. They were the plumbers, the maids, the front desk clerks. They created this unbeatable, low-cost model. And from that tiny start, they built an empire now worth over $40 billion. That right there is Dhandho in action. That story is absolutely incredible. But let's be honest, most of us aren't exactly lining up to run a motel around the clock, right? So that leads to the really important question, can we use this same low-risk, high-return idea somewhere else, without all that back-breaking, hands-on work?
Well, the answer is a huge yes. The book argues that, believe it or not, the stock market is actually the perfect place to practice Dhandho. It gives you 4 massive advantages over buying a whole business outright, like a motel. Let's get into them. First up, and this one's a game changer, is effort. Just think about Papa Patel having to be his own carpenter, plumber, and maid. I mean, that's 24/7 heavy lifting. Now, compare that to being a stock investor. You get to be a passive owner. The company already has a CEO, employees, a whole system in place. You don't have to fix the leaky faucets or check guests in at 3 in the morning.
It's basically the ultimate form of leverage. You get to be a partner in a business, you share in all the profits, but you don't have to do any of the day-to-day grinding. Okay, next is capital. Back in the 70s, Papa Patel had to scrape together $5,000 for a down payment. That was a ton of money back then. Buying a whole business takes serious cash. But the stock market, you can literally get started with the change in your pocket. It completely opens the door to business ownership for pretty much everyone.
Advantage number 3, this is where things get really interesting. Finding those amazing bargains. See, when you buy a private business, the seller's usually pretty smart. The price is rational, and they're selling when it's best for them. The stock market, though, has this character that Benjamin Graham famously called Mr. Market. And Mr. Market is, well, he's a little moody. One day he's ecstatic and thinks every business is worth a fortune. The next, he's panicking and wants to sell everything for cheap. And that's our opportunity. His emotional mood swings are what create these unbelievable sales on great companies. Charlie Munger put it perfectly. He said, investing is like betting at the horse track. You're not trying to guess the winner of every single race. That's a fool's game. You're just waiting patiently for that one race where, for some crazy reason, a horse with a 50% chance of winning is paying out 3-to-1 odds. You're looking for a totally mispriced bet. And the last big advantage is liquidity. If you want to sell a motel, it's a huge ordeal. It takes months, you've got lawyers, brokers. You can easily lose 5 to 10% of the value just in fees. Selling a stock, it's a few clicks on your phone and costs practically nothing. This means you can get in and get out instantly when the odds are no longer in your favor. So, we've established why the stock market is the ultimate Dhandho arena. Now for the million-dollar question. How do you actually find these low-risk, high-return deals? Well, that's where the Dhandho blueprint comes in. The plan for hunting these bargains is surprisingly simple. It comes down to 3 rules. First, only invest in simple businesses you can actually understand. Think furniture stores, not experimental biotech. If you can't explain what it does to a 10-year-old, stay away. Second, you want to actively look for trouble. The very best deals are found in good businesses that are going through a rough patch, usually in an industry everyone currently hates. And third, this one is non-negotiable. You have to demand a huge margin of safety. That's just a fancy way of saying you buy something for way, way less than what it's actually worth. This classic quote from Warren Buffett, it's really the heart and soul of the Dhandho approach. It's how you put those rules into practice. You find those beaten down, hated companies, and you have the courage to be greedy and buy them up when everyone else is running for the exits in a panic. Their fear is what creates your bargain. Okay, so you've been patient, you did your homework, you found that perfect, simple, distressed business selling for 50 cents on the dollar. So, What do you do now? This is where we get to the real secret sauce of the Dhandho method.
Now, this is going to go against almost everything you've probably been told about investing. Forget diversification. Dhandho is all about concentration. When you find one of those rare, mispriced bets where the odds are just overwhelmingly stacked in your favor, you don't just put a little bit of money in, you bet big. This means you're not making deals every day or every week. You might only find 1 or 2 of these golden opportunities a year, if that.
And there's even a mathematical tool for this. But don't worry, the concept is what matters. It's called the Kelly formula. All it really does is help you figure out how much to bet when you have a big advantage. The simple idea is this: the bigger your edge, your certainty of winning, the more of your money you should put on the line. It's a way to be disciplined about acting decisively when you know you have a winning hand.
So when you put this all together, what's the big takeaway here? It's about a fundamental shift in your mindset. You have to stop thinking like a stock picker and start behaving like a patient asset collector.
So what does that actually mean? It means you learn to be incredibly patient, waiting for that perfect pitch right over the middle of the plate. It means you completely ignore the day-to-day price wiggles and focus only on a business's real long-term value. You always demand that massive discount. That's your margin of safety. And then, when that rare, perfect opportunity finally shows up, you don't dabble, you act, and you act with conviction.
Here's the thing. The market, with Mr. Market's wild mood swings, is constantly serving up these kinds of potential opportunities. The Dhandho framework gives you the map to find them. But the biggest challenge isn't about being smart. It's about your temperament. So I'll leave you with this question. Do you have the discipline and the patience to just stand there, doing nothing, and wait for that one perfect shot?